Hello everyone. Welcome to another video lecture. Okay, so this video lecture will be a continuation of our discussion on the previous video lecture on valuation concepts and methods and the capital structure theories. Okay, so this time, since we already discussed the different capital structure theories, we will now tackle the factors that influence optimal capital structure. Okay? So now, what are the factors that influence optimal capital structure? First, we have here control. So, of course, the management control over the firm is one of the major determinants of capital structure decision. If equity shareholders do not wish to divide their control, the firm will rely more on debt funds rather than issuing additional equity shares. Okay, so of course, it would be the management who will determine as to what type of capital structure are they going to uh, employ or use, okay, in the day-to-day business activity. For instance, magkano ba or ano ba yung mix no ng debt and equity to finance, okay, their capital structure, okay, or to finance the day-to-day operating activities of the business, okay? Now, there are equity shareholders who don't want to, dilute their control, okay, over the entity. Okay? So, for example, if you have a 20% stake, no? Meaning you have 20% investment, no, you have 20%, you own 20% of the outstanding ordinary shares of the entity. So basically, you have what? You have significant influence over that company. So if you wish or if you want that you will not dilute your shares, kasi if the entity or if the company, okay, or the investee will invest or will issue more and more shares, then and if it so happen na hindi na kaya no ng mga investors or ng mga existing shareholders, especially those who have significant ownership, hindi nila kayang mag-invest pa. Okay, then it will result into what? A dilution no, ng kanilang control over that entity. Okay? Ayan. So, kaya naman, they may what? They may decide to just issue debt rather than issue more equity. Okay? Next, we have risk. Now, in capital structure decisions, two elements of risk, okay, is actually considered. First, we have business risk and financial risk. So, when you say business risk, ito yung riskiness, no, ng firm's asset if no debt is used. Okay? So, meaning, kung walang debt yung entity, yung business risk is, kumbaga, ito yung ito yung inherent risk. Okay? When you build a business and when you choose a certain industry. For example, if your business is, let's say, banking, okay, ano ba yung mga inherent risk ng banking industry if you do not have debt? Meaning, lahat ng yung capital is equity finance. Okay? So, ano ba yung business risk ng banking, no, ng banking business? While when you say financial risk naman is the additional risk placed on the common stockholders as a result of using debt. Now, of course, the management may proceed into what? Issuing debt securities to have more financing. Okay? So kapag nag-issue sila ng mga debt securities such as bonds, okay? Yung mangyayari is that there is additional risk, again, we call that financial risk. Yung financial risk, that is the additional risk na binibigay, or kino-consider ng mga equity shareholders because of the fact na nag-issue yung entity ng mga debt securities. Okay? So syempre, pag nag-issue tayo ng debt securities, may mga resulting risk. For example, tataas yung mas mataas ang, let's say, interest rates, okay? Or the risk na baka hindi kaya ng entity na bayaran yung fixed charges every month, okay? Or periodic fixed charges, Okay, and all other risks associated with financial risk. Of course, that will add more risk to equity shareholders. Baka kasi hindi nila na ma-recover yung kanilang investment, no, to the entity. Okay, so of course, that is considered when choosing the optimal capital structure. Now, income, of course, no, this is very common, no, kasi this is considered, no, as the impact of the method of financing, okay, on the common shareholders' earning per share, or this is what we call EPS, and the return or equity, on equity or ROE. Okay, now for example, if yung earning before income tax is low, okay, from EPS point of view, then the equity financing is preferable to debt financing. So sabi dyan, kung yung EBIT, yung earnings before interest and taxes is lower than the earnings per share, then wag ka nang mag-issue ng debt financing. Okay? Or ng debt security. Kasi kapag mag-issue ka ng debt securities, then your earnings before interest and taxes, you will have to what? You will have to deduct pa interest expense, no? Pambayad sa kayong mga debt financing. So, mas liliit at mas liliit ang EBIT. And at the same time, liliit din yung earnings per share. Kasi yung matira, after, for example, you have earnings before interest and taxes. Tapos, yung EBIT mo, you will have to deduct pa yung interest paid to the creditors. So, liliit na lang yung matitira for the equity shareholder. So, liliit din yung earnings per share. Okay? Now, if the EBIT naman is high from EPS point of view, then debt financing is preferable over equity. Okay, so kung mas malaki naman yung EBIT, yung earnings before interest and taxes, okay, kesa sa EPS, then it might be what? It might be preferable, no? Or favorable also to, issue debt securities. Ayan. Okay, so we have here financial leverage. So, capital structure decision should always aim at having debt component in total component in order to increase the earnings available for equity shareholders. So yung tendency kasi is when we borrow money to finance, okay, the operation, no, to finance the asset of the entity, it will give, no, the borrower the financial leverage. Okay, for example, liliit yung when you borrow money, liliit yung weighted average cost of capital mo because the interest paid to debt is actually a tax deductible. So magkakaroon tayo ng tax shield. But of course, no, based on the capital structure theory na na-discuss natin before, na kapag excessive na din naman yung debt financing mo, so liliit na yung what? Liliit na yung financial leverage mo. Kasi nga, tataas na yung, unti-unti nang tataas yung ating weighted average cost of capital due to the fact na mayroon ng mga additional risk, no, when excessive na yung debt financing. Okay? So generally, the cost of debt net of tax is lower than the cost of equity. Kasi alam naman natin that when you borrow money, the charge or the interest expense, no, or the interest that you pay periodically to a debt is fixed, di ba? So hindi yan nag-change over time. Mas mataas man yung profit mo or maliit man yung profit mo for that period, the same pa rin yung babayaran na interest mo. Okay, so mas, siya. Tapos, tax deductible pa siya. Di ba? Yung interest. If i-compare mo yun sa dividend, di ba? Dividend is what? Or cost of equity is actually what? Higher than cost of debt. Kasi hindi naman deductible yung dividend sa income mo in computing what? In computing your tax liability, no, for a certain period. And isa pa, yung dividend is, it will be based what? Based on what? On the, profit for a certain period, no? It will be determined by the board of directors. Ayan. So, any excess over cost of debt will redound to benefit, no, the equity stockholders. Now, debt capital is considered to have better flexibility than equity capital. Kasi when funds are required, debt may be what? Raised and programmed for payment after a fixed period, di ba? So kung nag-borrow ka ng money today, you can actually repay it after 1 year or after what? After 3 years. Okay, or you can actually pay it what? On a series of payments. So debt is actually flexible. Okay? Pre-termination of debt can also be worked out with the creditors. Pwede. For example, yung utang mo is 5 years, pero kung 3 years pa lang gusto mo nang i-full or i-fully paid, you can actually make an arrangement with the creditors. But you cannot do that with what? You cannot do that with equity shares. Bakit? Kasi you cannot return the capital of the shareholders, no? So, it cannot what? Equity shares cannot ordinarily be reduced except with the permission of the court, okay? And also, if nag-comply ka sa mga legal requirements. So, again, normally, you cannot return equity shares no sa mga shareholders. So, mas flexible pa rin si debt kaysa sa equity. So, tax consideration of the debt has tax advantage over equity. Bakit? Kasi nga, interest paid to debt is tax deductible. Timing, no, the time of which the capital structure decision is taken will also be influenced by the condition of the economy. Ayan. So, time, no? Or timing. So, we also have here profitability, no? So, yung mga entities na profitable, they do not necessarily what? Rely on borrowing external funds. Kasi kapag profitable sila, they can just what? They can just retain some of their profit to finance their financial needs. Okay? Ayan. So we also have here some factors no affecting optimal capital structures. We have marketability, okay, how you market your equity shares, no, mas marketable ba yung equity shares mo kaysa sa debt securities mo, okay? So we also have here company size, no? Kapag maliit yung business, okay lang na usually yung funding, no, kapag maliit yung business is what funded by the owner, okay? Pero as the business gets bigger and bigger, no, yung size niya, mas malaki na yung capital na kailangan niya. So it might need to seek for capital from the financial institutions or from equity investors. Okay? So we also have here sales stability, operating leverage, we have growth rate, and of course, itong management attitude. So, isa sa malaking factors ng optimal capital structure would be the attitude of management. Okay? If favorable ba no sa management or depende kung ano yung attitude ng management, no? If management is, confident with financing the entities, asset or day-to-day operation, if they are confident with financing it with debt, then they will go to debt. Okay, although they can also issue equity securities, but of course, if kung favorable sila to issue to issue debt, then they will really go to more debt than equity or the other way around. So depende na din yon sa management attitudes. Okay? Now, business and financial risk. So again, when you say business risk, ito yung riskiness no of the firm's assets if no debt is used. So normally ito yung risk inherent when you start a business, okay? And you do not have debt, so yung finances mo or yung capital mo is what? From equity finance siya. Okay? So ayan, so yun na yung example natin kanina sa bank, no? But when you say financial risk, ito yung added risk to the equity shareholders kapag aside from equity financing, meron ding debt financing. Meaning, yung pambili ng assets, pambayad ng utilities and operating expenses ay not just from, shareholders but also from creditors. So of course, if you borrow money, no, if you have debt, that will add what? Another risk, no, especially to the equity shareholders. So the risk na baka hindi na nila makuha yung kanilang investment or baka wala silang return on their investment and so on. Okay? Now, business risk is the single most important determinant of capital structure. Okay? And also it represents the amount of risk that is inherent in the firm's operation even if it uses no debt financing. So yun na nga. So, gaano ba ka-risky ang banking business? Okay? Gaano ba ka-risky ang banking business? Gaano ba ka-risky ang franchising business? Gaano ba ka-risky ang food business kahit na wala silang debt? No, if their financing is just equity financing. Gaano ba ka-risky ang type ng business? So ano siya? Kumbaga inherent na talaga siya sa business na 'yan. For example, your business is your business is social media. Meron kang social media business. Kasi nga nagmamanage ka ng mga social media personalities. So, inherently, ano ba yung mga, risk if, ano ba yung mga inherent risk o yung risk na talaga, normal na talaga siya sa social media, management na business. Okay? Yan yung business risk. So normally, the measure of business risk is the standard deviation of the firm's return on invested capital or ROIC. So to compute that, that's EBIT net of tax kasi nga EBIT multiplied by 1 minus tax. Okay? That's EBIT divided by investor supplied capital. So that's return on invested capital. Ayan. So, return on invested capital measures the after-tax refund that the firm provides for all of its investors. Okay? So, since ROIC does not vary with changes in capital structure, okay, it doesn't vary with changes in capital structure. Bakit? Kasi nga, di ba, business risk is the risk of, inherent risk in doing business if no debt. Okay? Ano lang, equity finance lang yung business. So it doesn't actually vary with changes in capital structure kasi technically wala naman talagang debt in this case. Ayan. Purely lang siya, equity finance. So the standard deviation of ROIC measures the underlying risk of the firm considering the effects of debt financing, thereby providing a good measure of business risk. So factors that affect business risk. So we have variability of demand, for the firm's product. Okay? So the more na mas marami yung demand for the firm's product, mas less yung business risk. Kasi kapag mas maraming demand, mas maraming sales. Diba? Now, competition. Pag mas maraming competitor, okay, mas maraming choices yung customers, so mas malaki yung business risk. Paano pag hindi bibili sa iyo yung mga customers? Paano pag sa mga kakompetensya mo? So, mas tataas yung business risk mo na baka wala kang sales. So, wala kang sales, wala kang what? Wala kang contribution margin. Kung wala kang contribution margin, wala kang what? Wala kang pambayad sa mga fixed expenses mo. Okay? And wala kang profit. Ayan. Next is we have variability of sales price. No? So, firms whose products are sold in volatile markets are exposed to what? More business risk than firms whose output prices are stable. So, other things held constant. So, kung volatile yung or mataas yung variability ng sales price mo, mas mataas yung business risk. Okay? Paano kasi kapag yung general price ng mga products na binenta mo in the market is liliit. So, of course, liliit yung gross margin mo and then everything else will follow. No? Obsolescence. Okay? So, kapag yung product mo is madali maging obsolete, meaning if you're not able to cope up with what changes in the technology, the advancement of the technology in developing new products, baka mas madaling ma-obsolete yung mga products mo. And of course, if products become obsolete, wala nang demand, liliit yung demand or no demand at all. So, malaking business risk 'yon. Okay? You have variability of product costs, diba? So production cost is actually this is a very important factor in considering the business risk of an entity. Bakit? Kasi kapag for example, you are selling in a very competitive market. So kapag nasa competitive market ka, you cannot generally raise your sales prices up. So paano naman kapag tataas yung production cost mo and you cannot increase or you cannot increase your selling price. So paano mo pa ma-recover yung cost ng product na binenta? Okay? So that's a factor to consider. Now, ito namang mga businesses that a large or majority of their sales happen abroad. So they also they also exposed into foreign risk. Okay? So ayan. So kasi nga they're subject to earning declines due to exchange rate fluctuation lalo na ngayon kapag tataas yung exchange rates, Okay, of course, and then foreign currency denominated yung sales transaction mo. So okay lang. Okay? Kasi nga, for example, you're selling in the US and kapag nagbenta ka sa US, tapos denominated sa in US dollars, so meaning when you sell products in the US, you will receive US dollars. So luckily, kapag i-convert mo siya ngayon into Philippine peso, mataas yung exchange rate. So mas maraming peso unit, no, Philippine peso unit yung ma-receive mo kapag ipa-convert mo yung US dollars. Okay, paano naman kapag liliit yung exchange rates? Okay, so of course, that also poses what? Some business risk, no? So they're also what? Exposed to what? Political risk. For example, ngayon, 'di ba? The war in Russia and Ukraine, no? That's part of what? That's really politics. Okay? So it is played by what? Their what? Their heads of state. No? So that's what? Politically motivated pa din. Okay? And of course, alam natin na we really felt no na kapag the ongoing crisis in Russia and in Ukraine, okay, it affects every country in the world. Kasi nga Russia is the third highest exporter of what? Oil, crude oil, no? They're also an exporter of wheat and yung mga steel, no? Yung mga bakal. Okay? So kapag ibaban sila ng mga importing countries, so maapektuhan yung supply chain, liliit yung supply pero the demand stays the same. So kapag liliit yung supply and the demand stays the same or the demand increases, so tataas talaga yung presyo. Kawawa yung mga maliliit at what? Poor countries. Diba? Okay? So legal exposure and regulatory risk, no? Especially if the firm is what? In an industry that is highly regulated by the government, so they are subject to changes in the regulatory environment, which may have a profound effect on the company's current and future profit. That's profitability. Ayan. So degree of operating leverage. So when a high percentage of total cost are fixed, so pag yung total cost mo, majority of which is fixed cost, the firm is said to have a what? High degree of operating leverage. So high degree of operating leverage, other factors held constant, implies na kahit maliit lang na change sa iyong sales, malaki yung what? Change sa iyong return on invested capital. Kasi nga, fixed cost, more of what? More of fixed cost man yung costs mo. So of course, kahit tataas yung sales mo, the fixed cost will stay the same. So kung tataas yung sales mo and majority of your cost is fixed cost, and the fixed cost will stay the same regardless of the level of sales, so mas tataas din yung return on invested capital mo. Okay? That's degree of operating leverage. Ayan. Now, financial risk, no? So na-mention na to kanina, the added risk placed on ordinary equity shareholders as a result of the decision to finance with debt. So conceptually, shareholders face a certain amount that is inherent in the firm's operation. This is its business risk. Inherent na talaga yan siya sa business na yan. When you start up a business, meron na talaga yung risk nakasabay. Okay? Now, if you borrow money, okay, if you, engage in debt financing, it will add what? Additional risk, no? Into your equity shareholders. Okay? Kasi nga, there is uncertainty inherent to the projection of future operating income. Baka hindi kayang bayaran yung interest, baka mabankrupt, or, all other, yung mga risk no, associated with borrowing money. Inflation, okay, volatility of interest rates in the market, and so on. Ayan. Now, we have here capital structure policy. So, na-discuss na natin last video lecture, no, yung mga capital structure theory. But you see, capital structure policy, it involves a choice between risk and expected returns associated with the firm's financing mix. Ayan. So, when you borrow, in a capital structure policy, when you say policy, polisiyan na talaga yan. So, ito lang dapat yung level of debt, ito dapat yung level of equity. Okay? So when you craft a capital structure policy, you have to consider the risk and return. Risk and return. No, when you say risk and return, when you borrow more debt or when you borrow more equity, you have to consider the risk. So pag mataas yung risk, dapat you need to make it sure, or yes, you need to what? You need to consider the possible return. Then baka mataas yung risk, maliit lang yung return. Okay? And then you still pursue with those risks. Di ba? So hindi naman makaturungan yan. Okay? Now in planning its capital structure, the firm's first major decision policy is the determination of the appropriate level of debt. Kasi normal naman talaga yung capital, di ba? When you start a business, hindi man pwede na mag-start ka ng business, utang mo lahat yung capital mo. Okay? Dapat meron talagang owner invested or yung shareholder na mga investment to start with. And then from there, you'll have to plan if you need to borrow money ba from creditors or no need to borrow money from creditors. Okay, and if you need to borrow money from creditors, how much? Okay, at what level? So as debt increases, the expected return on the firm's equity due to the expected return on the firm's equity increases. Dapat may word dyan increase, no? Due to the increased risk. So dahil nga, when you borrow more debt, tataas yung what? Financial risk. Mas tataas yung financial risk. So kung tataas yung financial risk, meaning mas mataas yung risk added or tumataas din yung risk added to the equity shareholders. So kapag mataas yung risk, they will require more return or higher return on their investment. So therefore, there should be a trade-off between risk and return when making capital structure decision. So kailangan talaga i-consider itong risk return. No? Again, in developing a capital structure policy. So the capital structure that balances risk and return to maximize the value of the firm is yung tinatawag na optimal capital structure. So the determination of a firm's optimal capital structure is actually what? Possible. Possible siya theoretically. Okay? But financial managers cannot determine with precision, kung ano ba talaga yung exact percentage ng debt and equity to maximize the market value of the firm. Remember that our job here is to what? To make the shareholders wealthy by what? By increasing the share prices. Okay? Kasi kapag mataas yung presyo ng share sa market, tataas yung what? Value ng investment ng mga investors. Okay? And to do that, how are you going to what? How are you going to do that? Okay? With regards to your capital structure. Okay? So in practice, finance managers set a desired or target capital structure. Although hindi talaga nila practically nako-consider or nadidetermine with precision the exact percentage of debt and equity. But again, in practice, meron lang silang desired target capital structure using informed judgment. No? How are they going to have an informed judgment? Market research, hiring market analyst, and research. Diba? Ayan. And some analytical approaches. Ayan. Now, we have here EBIT-EPS analysis. So, one commonly used analytical technique to evaluate various capital structure in order to select the one that maximizes a firm's earnings per share is itong tinatawag na EBIT-EPS analysis. EBIT means earnings before interest and taxes, while EPS means earnings per share. So, itong approach na to, it measures the impact of financing alternatives on EPS at different levels of EBIT. No? So, at different levels of EBIT, ano ba ang kanyang impact sa earnings per share ng isang entity? Okay? Ayan. So, another objective of EBIT-EPS analysis is to determine the EBIT-EPS indifference or breakdown or break-even points between the various financing choices. When you say indifference point, ito yung point or level ng EBIT na yung EPS of a firm is the same. Equal lang yung EPS ng firma kahit na anong alternative capital structure pa ang gamitin. For example, the indifference point of EBIT, okay, the indifference, the level of EBIT wherein indifference yung level, indifference yung kahit anong alternative ng capital structures. For example, at this level of EBIT, okay, at this certain level of EBIT, example at this certain level of EBIT, kahit na ano pang percentage ng debt to equity yan, okay, kahit pa anong percentage ng debt to equity yan, EPS will still be the same, or the earnings per share will still be the same. That's the indifference point. Okay? At EBIT levels above the indifference point, firms with more financially levered capital structures will produce higher levels of EPS. Meaning, if si EBIT is above the indifference point, if the earnings before interest and taxes is above the indifference point, the level of EBIT wherein EPS is the same. Firms with, if they are financially levered, meaning they rely more on debt rather than on equity capital, will produce higher levels of EPS. Kasi nga fixed man yung binabayaran nila sa kanilang creditors, di ba? Okay? So mas tataas yung EPS nila. Okay? Kapag yung EBIT is higher than the indifference point. But if EBIT levels below the indifference point, meaning if the indifference point of EBIT is here and the actual EBIT is below the indifference point, then less financially levered capital structures will produce higher levels of EPS. Okay? Now let's compute the indifference point. We can actually do that. No? So we have an illustrative case here. Okay? Now, La Vida Equipment Company's current capital structure consists of 8% debt with a market value and book value of 4 million and 200,000 shares of outstanding common stock with a market value of 15 million. So the firm is considering a 6 million expansion program using one of the following financing plans. So currently daw, meron doon siyang 4 million na debt. Okay, 8% yung interest rate dyan. Plus, meron din siya currently 200,000 outstanding shares na may 15 million market value. Now, nag-consider siya na mag-expand, okay, at kailangan niya ng 6 million in additional financing. So, meron siyang 3 plans kung paano niya makuha itong additional financing need niya. Plan 1 is magbenta ng additional debt. So, kapag magbenta siya ng additional debt security, magkakaroon siya ng 6 million in capital, additional capital through debt, and the interest of that will be 10%. Another plan niya is magbenta ng preferred shares, so mag-issue ng preferred shares, okay? Preference shares, and meron niyang 10.5% na dividend yield. Remember, fixed yung dividend yield ng preference shares at 10.5%. Plan 3 is magbenta ng ordinary equity securities. So magbenta daw ng ordinary shares instead of preference shares to get 6 million in additional financing. And the price of which will be at 250 pesos per share. Okay? Yeah. Now, the corporate tax or the tax rate or corporate tax rate is 34%. Okay? Ignore lang natin yung flotation cost. When you say flotation cost, ito yung cost no associated with issuing ordinary shares. Okay? So, ignore lang natin yung flotation cost. But the corporate tax rate in this case is 34%. Okay? Now, we have here the expected level of EBIT after the expansion is 2.5 million. So, the earnings before interest and taxes, after niya makakuha ng 6 million of fund in additional financing and mag-expand, the level of EBIT will now be at 2.5 million. So, the EPS for each financing plan is calculated as follows. So, computin natin yung EPS under plans 1, 2, and 3, considering 2.5 million level of EBIT. Remember, the same lang naman yung level of EBIT niya, right? Kasi nga, basta yung purpose is to get 6 million in additional financing. After that, mag-expand siya, the level of EBIT is at 2.5 million. Now, computin natin yung EPS under each of the 3 plans, no? Now, yung interest on existing debt, remember, meron siyang current debt na 4 million. Multiply mo yan by 8%. The current interest expense is 320,000. So, that will be applicable in all plans. Kasi nga, that's current. Okay? 320,000. That's 4 million times 8%. Ayan. minus another interest rate, another interest on new debt. Remember, it is only in Plan 1 na magbebenta siya ng debt securities. So, magkaka-incur siya ng additional 6 million debt. Okay? And that is at 10%. So, 6 million times 10% for Plan 1, additional debt, 6 million times 10%, the additional interest is 600,000. Okay? Yan. Remember, in Plan 2 and 3, walang additional debt. So, wala tayong additional interest on debt in Plan 2 and 3. So, the total would be, the total interest expense would be 920,000 for Plan 1, 120,000 naman for Plans 2 and 3. That's Plan 3. Ayan. So, earnings before taxes, that would be EBIT minus the total interest. So, in this case, that's 2.5 million minus 920, that's 1,580. That's 2.5 million minus 320, that's 2.5 million minus 320, that's 2,180 and 2,180. Ayan. Of course, kunin natin yung income tax. Sabi natin that the income tax is 34%. So, 34% of the earnings, di ba, yung basis natin sa tax is the earnings before tax. So, multiply mo lang to by 34%. Ito na yung income tax natin. 537,200 for Plan 1. For Plan 2, that's 741,200 and 741,200 for Plan 3. Okay? The net income would be earnings before tax minus income tax. That's the net income. Okay? Now, before natin i-compute yung EPS, kunin muna natin yung dividend to preferred shares. Remember, it is only in Plan 2 na mag-issue ng preference shares. So, yung may dividend lang din, isa na kukumputin would be for Plan 2 kasi siya lang yung mag-i-issue ng preference shares. Okay? And the yield is what? 10.5%. So, that would be 6 million na preference shares for Plan 2 multiplied by the dividend fixed no to preference share at 10.5. So, 6 million times 10.5%. That would be at 630,000. Okay, that's the dividend to preferred share. I-minus mo yan from net income, then you will get the earnings available to ordinary shareholders. So, itong earnings available to ordinary shareholders, yan yung i-divide natin by outstanding ordinary shares to get the EPS. So, in Plan 1, we still have 200,000 ordinary shares. Okay, this one, kasi wala mang additional ordinary shares in Plan 1. In Plan 2, that's still 200,000. Kasi nga, wala namang additional ordinary shares in Plan 2. It is in Plan 3 na madadagdagan yung ordinary shares. So, that's 200,000 plus, okay, 80,000. Bakit? Kasi that's 6 million yung kailangan niya na financing. So, kapag mag-issue siya ng ordinary shares na may presyo na 150, so that's 6 million divide 150. That's 80,000 in additional ordinary shares. Okay? So, the total ordinary shares in Plan 3 would be 200,000 plus 80,000. That's 6 million divide 150. So, 200 plus 80,000, that's 280,000. So, ito yung outstanding ordinary shares under Plan 3. Again, Plan 3 ni siya. So, the EPS is i-divide mo lang, no? Earnings available to common shareholders divided by ordinary shares outstanding. Okay? So, the EPS under Plan 1 is 5.21, 4.04 in Plan 2, and 5.14 in Plan 3. So, pinakamataas yung EPS natin at 5 at in Plan 1. Kasi in Plan 1, that's at 5.21 yung EPS. Okay? Yan. Now, next would be to compute for the indifference point. So, hanapin natin yung EBIT, the amount of EBIT or the level of EBIT na yung EPS would all be the same. Okay? Before that, let's take a look at the graph here. Okay? So, itong first line natin, that's for Plan 3 na may ordinary shares. Okay? Yung second graph is for Plan 1 na we financed the additional 6 million in financial need through debt. And the graph number 3 is yung nag-issue tayo ng preferred shares. As you can see, yung may intersection lang is yung debt and ordinary shares and the debt and the preference shares. Okay? So, walang intersection. Okay. So, figure 10 shows that there is one indifference point between debt and ordinary equity share and another between preferred share and ordinary equity share. So there is no indifference point between debt and preferred share because debt dominates preferred share by the same margin through the EBIT and EPS. Ayan. So kasi yung binabayad din kasi natin sa preferred share is fixed din kasi. So yung may indifference point lang is yung intersection ng debt and ng kapag nag-issue tayo ng ordinary share which is at this point. Okay? Ayan. Now again, this time, compute naman natin yung indifference point. No? So to compute the indifference point, we have here letter A. Okay? For letter A, let's get the indifference point of EPS na may debt for Plan 1 and EPS with ordinary equity shares for Plan 3. Okay? So this is in thousands. So that would be EBIT, earnings before interest and taxes, minus total interest. Diba the total interest for Plan 1 is 920. Okay, if you take a look at here, that's 920. So minus 920. Remember, EBIT minus interest, that's earnings before tax. Multiply mo yan by 1 minus 34 to get the net of tax or the net income. Ayan. Minus 0. Bakit minus 0? Kasi wala naman tong, in Plan 1, walang preference share. Remember, walang dividend sa preference shares in Plan 1. Kasi in the first place, in Plan 1, walang preference shares. Okay? So, walang 0 lang yan dyan. The 0 dyan is the amount paid to preference shareholders. So, 0 for Plan 1. Divided by the total number of ordinary shares. That's 200,000. That's in thousands. Dito naman would be the EPS if mag-issue ng ordinary shares. So, that's EBIT minus 320. Bakit 320? Kasi in Plan 3 yun the total interest is just 320 since walang issuance of debt in Plan 3. So, that's EBIT minus 320 and EBIT minus interest is earnings before tax. I-multiply mo siya by 0.66 kasi 1 minus 0.34 is 0.66 to get the net of tax. Minus 0. Bakit minus 0? Kasi wala na, in Plan 3, we're not going to pay preference shares. Bakit? Kasi nga wala namang preference shares in Plan 3. Ayan. So 0 pa din yan dyan. Divided by 280,000. Bakit 280,000? Kasi nga in Plan 3, there will now be a total of 280,000 ordinary shares. So let's divide to 80. Okay, to get the EPS, the EBIT, okay, the indifference point, perform muna natin, okay? That's 1 minus 0.34, that's 0.66. Ayan, 0.66 minus 0. So cross multiply lang natin. When you cross multiply that, that's 280 times EBIT. So 280 times EBIT minus 920 times 0.66 minus 0. That's 280. Ito, cross multiply here. That's 280,000 times 0.66. Bakit? Kasi 0.66 times EBIT minus 920, that's 0.66 EBIT minus 0.66 times negative 920, that's negative 607.20. Okay? Minus 0, so wala na yan kasi 0. Equals, cancel out na yan. 200 times this one, 200 times EBIT minus 320 times 0.66. So 0.66 times EBIT, that's 0.66 EBIT. 0.66 times negative 320, that's negative 211.20. Okay, so tapos na tayo mag-cross multiply, then perform, no? 200 times 0.66 EBIT is equal to 184.8 EBIT minus, 107, okay, 107,000, okay, 0, 1, 6. Okay? Wait lang That's 280 times So that's 280 times negative 607.20. That's 170,016. Okay? Is equal to 200 times 0.66 EBIT. That's 132 EBIT. Minus 200 times negative 211.20, that's 42,000, negative 42,240. Okay? So, lipat natin lahat ng EBIT in this side, lipat lahat ng walang EBIT in this side. So, paglipat natin, kani mahimo ning minus. Positive 132 EBIT man. So, pag abot din, mahimo ng negative. So, 184.8 EBIT minus, minus man ni pagbalhin din. 132 EBIT, that will be 52.8 EBIT. Is equal to, ito, negative man to, di ba? Pag ilipat natin dyan, may mo na ng positive. So, positive 170.016 minus 42.240, that's 127.776. So, para EBIT na lang mabilin dire, that's divide 52.8 EBIT. So, makancel ang 52.8, makancel 52.8, mabiling EBIT. So, divide mo din dito by 52.8. Okay? That's 127,776 divided 52.8 EBIT. That's 2,420. That's in thousand. So that's actually 2,420,000. That's the indifference point. Okay? That's the indifference point. Now, the same procedure, no, for letter B, if there is EPS, if the EPS, the EPS when there is preferred shares, and the EPS when there is ordinary shares. So, basically, this is plans 2 and 3. Plan 2 and 3. Ayan. So, the indifference point naman nila, class, is, that would be EBIT minus 320. For plan 2, di ba, the total interest for plan 2 is 320 pa din. Tapos, times 1 minus 0.34 kasi nga net of tax pa din yan. To get the net of tax, earnings before tax. Minus 630. Bakit nag minus 630 tayo dito? Kasi nga, for plan 2, the earnings per share kapag may preferred share, meron na ngayong, ayan, nawala. Okay. Meron na ngayong 630 na, 630 na dividend to preference shareholders. Kasi nga in plan 2, di ba, we issue preference shares. And when we issue preference shares, we will now have 630,000 preference dividend to preference shareholders. Okay, nag-minus 630 tayo dito. Okay? Divided by 200,000 number of ordinary shares. Is equal to for earnings per share kapag merong ordinary equity share. So basically, this is on plan 3. So EBIT minus 320, 1 times 1 minus 0.34 minus 0 divide 280 or 280,000. So the same lang yan dito, no? Ayan, same lang yan. And then perform, just like what we did kanina for letter A. Okay, just cross multiply and then perform, no? So the EBIT here, the indifference point of EBIT, no? Meaning yung intersection dito ng preference and ordinary shares, that would be a 3,660,900. So plan 1, issue debt is favored over plan 2 to issue preference shares at all levels of EBIT. Plan 1 is favored over plan 3. Okay? Ordinary equity shares when EBIT is above the indifference point of 2,420,000. Again we what? We favor plan 1. Okay, plan 1 na mag-issue ng debt. Okay? To sell additional debt securities to finance the 6 million financial needs. Okay? Over plan 2. Okay? At all levels of EBIT. Ayan, at all levels of EBIT yan siya. And plan 1 is also favored over plan 3 na mag-issue ng ordinary shares kapag si EBIT is above the indifference point. Kasi di ba sabi natin na kapag si EBIT is higher than the indifference point, magkano ba yung EBIT natin dito? Di ba 2.5 million? Yung indifference point natin is 2,420. Okay? 2,420. So, favor natin yung EBIT kasi nga favor natin yung plan 1 mag-issue ng debt kasi sabi natin kanina na kapag yung EBIT 2.5 million is higher than the indifference point na 2,420 or 2,420,000, then financially levered firm, meaning when I say financially levered firm, yung firms na mag-prefer nila to finance the financing need with debt rather than equity. So, financially levered firm will actually produce a higher EPS, no, than those that are, not financially levered firm. So in this case, kasi nga 2.5 million yung EBIT dito compared, which is in plan 1, which is actually higher than the 2,420 na indifference point. So, mas prefer natin si plan 1 over plans 2 and 3. Okay? Ayan. So, for Plan 1 and Plan 2 naman, okay, Plan 1 and Plan 2, at all levels of EBIT, we will consider Plan 1. Okay, kasi nga, if you can see here, the 2.5, in 2.5 million level of EBIT, mas mataas yung EPS, which is 5.21 as compared to the 4.04. Okay? So, we choose Plan 1. Okay? In, if the EBIT is 2.5 million compared to Plan 2. Ayan. Okay? Pero kung yung EBIT natin dito after expansion is less than 2,420, yung indifference point natin kanina, this one, if the EBIT after expansion is less than 2,420, or you do not choose Plan 1 over Plan 3. You choose Plan 3. Kasi sabi kanina that if the expected EBIT is below the indifference point, then less financially levered firm will produce higher EPS. Okay? Yeah. So that ends our video lecture for today, no? The factors influencing optimal capital structure and the EBIT-EPS analysis.